Hi, everyone. I'm Rita Garwood, editor-in-chief of ABF Journal. Joining me on the podcast today is Brian Rosa. Thanks for being on the podcast, Brian. Can you introduce yourself? Tell us a little bit about what you do.
Yeah, of course. Thanks, Rita. Thank you very much for having me. My name is Brian Rosa. I'm the president of our asset finance business at Mitsubishi HC Capital America, and just thrilled to be joining you today.
Awesome. So, Brian, you've noted that while bank retrenchment is a known story in our industry, the collaboration that's going on between banks and independent lenders is the real underreported dynamic happening. Why is this partnership model accelerating right now?
Yeah, it's a great question, and it certainly is accelerating. I think if you've been paying attention, to the headlines over the past couple years, it seems like there's maybe upwards of, 15 to 20 partnerships that have been announced, and I'm probably missing some too. When you look at what's going on right now, and maybe some of the challenges that both banks and independents are having, I think it points to why there has been, acceleration. So if you look at banks, right, there's tighter regulation, tighter capital requirements. They're becoming a lot more selective about loans on balance sheet. There's strategies in some areas to shift to more asset light model, fee generation versus putting, lending products on the books, reducing credit exposure. Customers, I think, of these banks, are looking for comprehensive set of solutions. And if banks feel like they can't offer, lending product in certain areas, then they become less sticky. The customers become, less sticky to the banks, and so banks want to solve that. And if there's a certain portion of the credit market that they can't solve for, they're looking more to independence now to kind of fill that void. So there's been kind of a natural, I think, shift to them collaborating more with private lenders. Now, if you look at the challenges that independents are having, right? A lot of dry powder. They're looking to put that capital to use to generate yield. A lot of these independents are smaller in size and don't have the expansive kind of business development networks that maybe some of the bigger banks do with large relationship management networks. So this is a great opportunity for independents to put their capital to use and leverage the connectivity that the banks have with the market. And so there's a natural alignment and incentives for both when you take a step back. The banks get the benefit of preserving those customer relationships. They're able to offer an expanded product set and remain sticky with their customers. So customers are less likely to go shopping elsewhere for their financial services and products. Banks are also able to reduce their balance sheet, reduce credit exposure, and just continue to provide that kind of comprehensive solution to their customers. The independents on the other side, like I mentioned, they get that access to a much larger origination channel. It's pre-screened deal flow a lot of the time, so they're leveraging maybe some of the credit resources that the bank has had. We're able to also work with banks not only to fund transactions that they can't do, but maybe co-invest. There may be elements to that transaction that we're comfortable taking the risk on, where we can offer them a senior debt position, and there's ways that we can collaborate on that as well. So there's really big benefits for both, for the banks and the independents. And when you look at our current environment right now, a lot of volatility in the market, right? We've been dealing with tariff issues over the past couple years. There's the war that we're talking about right now. And, there's a real benefit to kind of having a seamless solution for these customers in the market. When the market changes like this, there's times when banks exit the market and their customers are looking for solutions. When you collaborate like this between the independents and the banks, you're giving customers that peace of mind that they're going to have an option, for financing, no matter what the economic conditions are.
So, Brian, would you say that this is primarily a reaction to capital requirements in Basel III, or is there more of a fundamental shift in how banks are viewing their specialized lending desks?
Yeah, I think, some of the regulatory issues is definitely a catalyst, but I don't think it's the primary driver. I mentioned before that I think a lot of banks are turning more into relationship platforms, targeting fee generation versus the big focus on putting more assets on balance sheet. So, I think over especially the past 5 years, there's been kind of a natural progression to shift. The regulation has certainly probably expedited and accelerated some of the need to partner with independents. I think Also, there's been credit volatility in certain sectors over the past 3 to 5 years that has made banks take a step back in sectors and say, hey, do we want to be here? Is this core to us? And they've been exiting and maybe optimizing the way they go to market. And that's created a void that, that independents can come in and fill for banks, and why it's, again, beneficial for both of them to be working together.
So when we talk about creative structuring, how do those deals actually land on your desk? Are banks increasingly acting as the front door for originations while Mitsubishi provides the specialized underwriting and capital, or is there something else going on?
Yeah, I mean, so at MHCA, deals come to us through a variety of channels. We work with banks, OEMs, distributors, integrators, brokers. So we see kind of deals from all over the place. A lot of the times when we're seeing transactions come through our banking partners, it can be maybe out of the box deals that they're, not comfortable doing. It could be non-standard collateral, could be longer, or maybe more customized amortization profiles, maybe unique credit profiles. Maybe there's some exposure issues the bank has been having, or maybe asset heavy structures that they can't improve internally. We have a banking partner that's not comfortable taking, residual risk on operating leases. That's one of our focus areas and specialties. And so we have a great partnership with them on any type of fair market value leasing product, operating lease product. So yeah, I think, once the deals come through the banks, then I would say we work pretty closely with the bank, with their business development team. And it's both the deal team from both the bank and us that are working together on that transaction. What's critical is that we kind of have one cohesive face to the customer. So when they bring us the transaction, very often it's our business development team working closest with their business development team. And then we're able to leverage whatever kind of underwriting the bank has already done or what intel that they have on the customer. We will bring that into our deal team and run it through like we would any other normal deal, making sure we keep that kind of consistent face to the customer, because that is the key thing in these relationships. Is really the bank is the anchor to the relationship, and we respect that and know where our role is. We do need to make sure that we are interfacing with the customer, but the key to success in these relationships is a collaborative effort, from both the bank and the independent to make sure the customer is getting a good experience.
So you've mentioned that the industry is moving from pure lending to being a solutions provider. In a bank partnership, what does that look like? Are you offering things like remarketing or trade-in programs that a traditional bank simply isn't equipped to handle?
Yeah, sure. So, it's really our objective to evolve from being just a pure lender into a full life cycle asset management provider. So we have a number of strategies in place that that are occurring over the next few years, where that is our main focal point. We believe that we can't just continue to be only a lender, and that we do need to expand into these other service areas. Where that helps us with banks is, number one, we're providing their customers with maybe an asset solution that they haven't had previously. What it also does, as far as how banks view us as an independent, it allows us to offer maybe some value that other independents aren't offering banks. So it makes us, a more unique and ideal solution for them when they're dealing with their customers. The specific capabilities that we've developed and are really excited about over the last year is we've entered into a exclusive partnership with a transportation and construction dealer that allows us to value assets better, which helps during the underwriting process. At end of lease, we're able to take equipment back and sell it through our auction and direct sales channels. We're able to offer that same service to the bank and their clients as well. And in fact, some banks we have on as clients through our remarketing division, because they have exposure in transportation and construction, and they're dealing with equipment that's coming back off lease. They're able to partner with us to make sure that they can monetize those assets, provide good services to their customers. And it really puts us in a unique position among other independents to provide that value to banks, which has been a big plus over the past couple of years.
So we've all been hearing a lot about AI and the data centers that support them, with the massive capital needs that those centers require. Are you seeing banks look to partners like you to help share the risk and technical underwriting of highly specialized and rapidly evolving assets that are linked to AI?
Yes, absolutely. I mean, AI in the data center construction space is just massive right now. Capital needs are massive. It's a constantly changing dynamic. There's just a lot of projects that are in progress right now, and banks are looking for risk sharing partners. And we are happy to step up and do that. We have a dedicated team here and have spent a lot of time over the past 3 years developing that expertise in AI and data center space so that we can participate in this, evolving industry. It's the demand's not going away. It is capital intensive. I think the value that we're able to provide is not only on the project finance side and the construction of these major facilities, but in the unique equipment needs of these AI companies as well. I mean, these require massive compute. There's just a lot of large scale equipment needs that need to be addressed with companies ranging from investment grade, very well established, down to startups, and they all are really really competing for capital in the market right now. And we're happy to be able to participate and provide some solutions in that space because the demand's not going away. It's an area we're going to remain ultra focused on, and so it is a key area where us and banks are partnering on right now.
So you've already spoken to this a little bit, but there is always a concern in referral partnerships about the handoff. How do you ensure that there's a seamless experience for the borrower so they don't feel like they're being bounced between institutions?
Sure. Yeah. I mean, the customer's experience is key, right? If the customer isn't having a good experience, then it just doesn't work. And we know that's especially a sensitive topic when we partner with banks, right? I mean, the thing that we're always very sensitive to is this is a banking relationship. They're offering a number of different products. We're just kind of one part of the machine for them, and we need to make sure that we are executing like we can, and so that it's a seamless experience for the customer. So MHCA is unique in that we have both big ticket and small ticket or flow capabilities. So on the big ticket side, it's typically larger transactions in our world. That's 3 to 5 million up to 50+ million. And then on a small ticket or flow side, it's typically 2 or 3 million and below. And so each kind of has a different customer experience, right? So big ticket side, we want to work with the bank's relationship manager to make sure that we level set on what our risk box is, our underwriting process, how we do documentation, so that they know where our comfort zone is. The last thing that we want them to do is go to their customer and overpromise on a solution that they think that we can provide, only get to the 1 yard line, and then we can't get the deal done. And, the bank relationship manager looks bad, we look bad, everyone looks bad, the customer's, not happy. And then that puts maybe the bank's relationship in jeopardy for some of the other services they're providing. So it's really critical that we execute. What we found on the big ticket side is that we have our own business development team that works very closely with the relationship managers and really remains entrenched throughout the whole selling process. So we're on the same page on what we can offer, how it needs to be structured, and that we give the bank the comfort that their relationship manager is still controlling the relationship. And so the more our deal teams can be connected throughout that process, the better, and we've seen better results. Now, on the small ticket and flow side, which is a lot more systems driven and automated, we're going to have a lot more, I would say, interface with the customer. So that is really about getting the bank more comfortable on how our underwriting process works, documentation, customer service once the deal is booked, the funding process. And while we're interacting with the customer a little bit more face to face there, I think it's just getting the bank and the deal team more comfortable with what our process is so that there's no hiccups or surprises when we go to the customer. So we found both on the big ticket side and the small ticket flow side, that's been a winning solution. We go through hiccups through every partnership like everything else, but we found as long as both sides are really proactively collaborating, it's been a positive experience for the customer.
That's great. So you've spoken about telematics and analytics and how they're reshaping underwriting. Are banks starting to leverage your data insights to help them understand the risks that they've previously could not quantify?
Yeah, sure. So I think I wish that they were, and I think we're still in the early stages too. So we want to get there, but it's probably not happening a lot right now. I think everyone realizes the value and kind of the need for the data and that we're able to extract through telematics and in other areas as well. But I think we're still in kind of the early stages right now. And if you look at banks and a lot of the regulatory requirements and operational constraints that they have, sometimes adopting that data can be difficult to do. But I do think over time and really in the next 3 to 5 years, they're going to look to leverage the data that we're providing through, the usage data we can pull on our leases and loans and be able to use that to drive the way that they underwrite transactions and really look at risk.
So this partnership between banks and independents, do you see it as more temporary, or do you see it more as a necessity? And do you think that we're entering a permanent new era where banks and private credit players are operating as a single integrated ecosystem for small business capital?
So I think time will tell, right? And I think we'll have to see the success of some of these programs that have been announced, in the market and what works and what doesn't. I mean, we certainly have a biased view and hope that it's permanent because it's a really efficient way to approach the market. If we can collaborate with banks, then you're really giving customers a much more seamless experience, and they'll have a lot more certainty that they can go out and find financing and other solutions. I do know that, especially on the small ticket side, I think the speed and the flexibility that customers demand is something that really requires probably a bank to work closely with an independent like us. And, if you look at the capital cost regulation and maybe borrower expectations of the banks in the long term, there's an argument that can be made that it should be permanent and hopefully will be permanent. But again, I think time will tell, and there'll be probably a variation of different outcomes from some of these partnerships that have been announced. So you'll be curious to see which ones stay in place and how they were successful and kind of learn from that. But it has the chance to be kind of a permanent solution going forward.
So, Brian, what would you say is the biggest misconception that traditional bankers have about partnering with independent lenders?
Sure, I think sometimes, the natural thing that we've seen is viewing us as competitors, right? Rather than a complementary partner that can allow a bank to continue to hold on to their share of wallet with that customer. I think it's natural for an independent to come in and be viewed as a competitor, right? We're offering somewhat similar products, maybe, different variation on structures and maybe credit appetite, but and this is why there needs to be collaboration, especially amongst the relationship managers and relationship managers and the business development folks from the independents. Is you need to have that one face and consistent messaging to the customer. And if we can be aligned in that way at the very beginning to the customer, and you build that trust between the bank and the independent, then the fear that we're going to be competitors kind of goes away. But it takes a lot of collaboration between both parties. I think one of the concerns also is that maybe there's, a lack of banks maybe view that there being a lack of sophistication in the underwriting on independence. And, I don't think that's true. And especially the sectors that we focus on, we have a lot of deep expertise here. And so I think it's maybe just natural. Banks are large, have access to a lot of resources. They may look at a smaller independent and say, hey, these guys don't have the capability to do it. But we've kind of proven time and time again that we do. And then lastly, I think just maybe fear of dilution of the relationship. The more people that are involved in a relationship, maybe sometimes the more complex it can get. The best transaction is typically a bilateral one where there's just two parties that need to agree on terms. When you enter, if you bring in a third party like an independent, banks can sometimes get concerned that it can become too complex, and then maybe the relationship suffers because of it. Again, going back to the original point I made on just collaboration, as long as you have kind of strong collaboration and alignment in place at the beginning, then that shouldn't be an issue.
So, Ryan, last question I have for you. If you were to pick one sector where you expect banks and independents to collaborate the most by the end of the year, which one would it be?
So I'm going to cheat, and I'm actually going to say two, but the top one is definitely AI and data centers and technology. I mean, just what I mentioned before, the capital needs, and I think just the spectrum of type of obligors that need access to credit right now. I mean, it's already exploding. It's going to continue to explode. I think everyone's still learning about who the winners and losers are, who's going to be, around long term. And I think that's driving a lot of the credit decisions in the market right now. There's certainly a lot of deals that we are seeing right now that maybe we can't do, but we're working with other partners that can do them. And there's deals that banks can't do that we can do. And I just think that kind of cycle is going to continue definitely over the next 12 to 24 months, but there's just obviously a massive opportunity there. So that's number one. And then number two is just robotics and automation in both manufacturing and then warehouse logistics. We see a lot of opportunities through our industrial group there right now. It's an area that we really like, and we understand the assets very well. There is a migration and a big scale investment right now in these facilities in robotics and automation. And these are complex installs too. This isn't something that you just go out and buy a piece of equipment, install it, and it's working within a couple of days. These are large scale integrations where we have a lot of experience working with integrators to make sure that we're providing kind of like a seamless experience for the customer. They're working with several OEMs, several service providers. We have a lot of experience working with the integrators to develop a financial solution for the customer. And we've added a lot of value to the banks as well. They've come to us with some bigger customers. They don't understand kind of the install projects that are happening, and we've been able to kind of consult them on that and then help their customers. So, but yeah, big opportunity there.
That's great. Well, Brian, thank you so much for being on the podcast today and sharing all of your insight. We really appreciate it.
No, of course. Thank you, Rita, so much for having me. I appreciate it.